Tell me if this sounds familiar. You check your credit score more than once a month. You feel genuinely good when it goes up. You feel stressed when it drops, even by 5 points. You've made financial decisions specifically to protect that number. Most Americans live like this, and the credit industry loves every single second of it. Because here's what they never tell you. A perfect 850 credit score and $0 in savings will not save you in a financial emergency. It will not fund your retirement. It will not build generational wealth for your family. Your credit score is not a measure of financial health. It is a measure of how well you manage debt. And those are two very different things. Now, before anyone comes at me, I'm not saying credit scores are useless. They're not. They matter for specific things. Getting a mortgage, renting an apartment, sometimes getting a job. In those moments, your score is genuinely important, but that's not how most Americans treat it. Most Americans treat their credit score like a report card for their entire financial life. Like if the number is high, they're winning, like it's the goal. It's not the goal, it's a tool. And when you confuse a tool for a goal, you make decisions that serve the tool, not yourself. Here's what I mean. In 2026, the average American carries over $6,000 in credit card debt. The average credit card interest rate, just under 22%. 22%. That is not a coincidence. That is a business model. And that business model works because millions of Americans are more focused on keeping their score high than on eliminating the debt that is actively destroying their financial future. Let's talk about how the credit score system actually works, because most people have no idea. Your FICO score, the one most lenders use, is made up of 5 factors. Payment history is 35% of your score. That's whether you pay on time. Credit utilization is 30%. That's how much of your available credit you're using. Length of credit history is 15%. How long your accounts have been open. Credit mix is 10%. Whether you have different types of debt. And new credit inquiries is the final 10%. How recently you've applied for new credit. Notice anything? 4 out of 5 factors require you to have and actively use debt. The system is literally designed so that the only way to have a great score is to be a great debt manager. Not a great wealth builder. A great debt manager. You want to know what does not factor into your credit score at all? Your income, your savings, your investments, your net worth. You could have $500,000 in a brokerage account and a 6-figure salary. And if you never use credit, your score would be low. Meanwhile, someone drowning in debt, paying the minimum on 5 credit cards every month, could have an 800 score. Think about that. And who invented this system? The Fair Isaac Corporation, FICO, created this scoring model. The same company that sells score monitoring services, credit improvement tools, and consulting to the very lenders who use the scores. They profit when you are obsessed with your number. Every app that shows you your credit score for free. It makes money by selling you financial products, usually credit cards and loans. The system is not neutral. It has a business model. And that business model depends on you staying focused on debt. Here's where the trap really snaps shut. When you are obsessed with your credit score, you start making decisions that are actively bad for your wealth. Example 1, you want to close an old credit card you never use. Smart, right? Less temptation, simpler life. But closing it would shorten your credit history and lower your available credit, both of which hurt your score. So you keep the card open. You keep managing it. You stay in the system. Example 2, you get a balance transfer offer. Move your debt to a new card with 0% interest for 18 months. Mathematically, this makes sense, but you hesitate, because opening a new card means a hard inquiry. That drops your score a few points temporarily, so instead of saving hundreds in interest, you protect your score. You just paid to keep your number pretty. Example 3. And this one is the most dangerous. People with high credit scores get pre-approved for things constantly. New credit cards, personal loans, car financing, buy now, pay later. And because their score is high, the offers feel like validation, like proof that they're doing well. So they use it, and the cycle continues. High score, more access to debt, more interest payments, more focus on managing that debt, less focus on building actual wealth. That is the trap. So what should you actually be focused on? 3 things. Number 1, net worth, not credit score. Net worth is assets minus liabilities. What you own minus what you owe. That number tells you exactly where you stand financially. Not a 3-digit score designed by a company that profits from your debt. Start tracking your net worth monthly. A simple spreadsheet works. Savings, investments, property value on one side, debts on the other. The difference is your real financial score. Number 2, pay off high-interest debt aggressively, regardless of what it does to your score. Credit card debt at 22% interest is a financial emergency. Paying it off might temporarily affect your utilization ratio. Your score might dip. That's fine. A slightly lower score with 0 credit card debt is infinitely better than an 800 score with $6,000 accruing interest at 22% every month. Do the math, not the feelings. Number 3, build your score to a functional level, then stop optimizing. Here's the truth about credit scores most people don't know. You don't need an 800 to get the best mortgage rates. Most lenders offer their best rates starting around 740 to 760. Get to 760. Keep your oldest accounts open. Pay on time. Keep utilization below 30%. That's it. You're done. Stop checking it weekly. Stop stressing over 5-point fluctuations. Redirect that mental energy toward investing, income growth, and building actual assets. That is what moves the needle. Your credit score is not your enemy, but it is not your friend either. It is a tool that has a very specific, limited use, and the financial industry has spent decades convincing you that it's the most important number in your life. It isn't. Your savings rate is more important. Your investment returns are more important. Your net worth trajectory is more important. The Americans who build real wealth are not the ones with the highest credit scores. They're the ones who stopped playing the debt management game and started playing the asset building game instead. Pause. Warm. Direct close. This week, pull up your net worth, not your credit score, your net worth. Write down every asset. Write down every debt. Do the math. That number is your real starting point.